Okie dokie, everyone. Can I start off by saying either a good morning or good afternoon or even a good evening, depending on where you are around the world. And thank you and welcome for joining me tonight on tonight's ladies episode of How I Got Into Trading series for Stratton Markets, obviously. Now, tonight's episode is called How I Came to Understand How to Trade the News. Written by myself, of course, which is James Trescothick, and I'm the head of investment research here at Stratton Markets. Now, before I get on to the usual introduction on myself and tonight's agenda, bear in mind we're talking about online trading and CFD trading. And like with all types of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your due diligence and know the risks at hand before entering any trade. Now, with that out of the way, this is myself. My regulars out there see I've actually changed the picture of myself. I'm still hairy. I'm still very wrinkly and very tired looking, but it's a bit more chilled and relaxed look instead of my usual picture. Now, like I said, my name is James Trescothick, and I'm the head of investment research here at Stratton Markets. Now, I have over 20 years experience in the financial service industry. I actually started off at the age of 18 in mortgages before moving into pensions and then alternative investments. Got into trading around about 13 years ago. I have indeed traded myself for several prop companies. I ran a floor at the Philippine Stock Exchange, ran a team of portfolio managers, and that's, like I say, I am a head of investment research, which is in charge of looking for market opportunities and things of that nature, as well as the education. I'm a published writer, and I've been published in several leading industry publications, including the likes of the Financial Times Advisor, Market Watch, The Street, FX Traders Magazine, etc., etc. I'm an avid market commentator. I'm very passionate about the market, believe it or not. And I'm a well-known public speaker, and I've spoken at several events around the world, including the likes of Dubai, Qatar, Kuwait, Saudi, Singapore, South Africa, London, just to name just a few. Now, tonight's agenda, like I say, is about how I started to learn how to trade the news events. This is, like I say, it's a short, this is part one, because though I will discuss at the end of this, as you will see from my agenda, I'll discuss one strategy. I will do a later episode where I'll go into a lot more strategies about trading news events. But so really, like I say, tonight's agenda is why trade the news? Why is it important? Economic indicators that can indeed affect the market. Politics and market drivers. We'll discuss how politics have got quite involved in obviously market movements nowadays. Two methods of trading the news. The straddle strategy. How to prepare your trading day. The up-and-coming educational events, which is really the June webinar schedule, and obviously the usual question and answer session. Like I say, this is part one, so I'm going to discuss one strategy today, which is the straddle strategy. In later episodes, I will discuss other strategies. So, in a nutshell, why trade the news? Now is the question. It's not just stocks, obviously, but so I'm going to focus a lot of it sometimes on currencies because there's a lot more news events which can affect currencies more than there is for stocks. But the same is for the stock, and I'll do a comparison. Now, here's a question. In general, what makes one currency stronger than the other or weaker against the other? Here's the thing. A strong economy equals a stronger currency. Of course, you can put that in relation to stocks as well. A strong economic or strong profitable company equals a stronger stock price. Okay, but for this, let's just keep on currencies. Okay, so a stronger economy equals a stronger currency. So the news, when related to currencies, really include economic indicators. And there are several economic indicators out there on a regular basis, which is news stories, which can indeed move the market. Now, some examples of these indicators, we'll go into a bit of detail a little bit more on a handful of them, such as the Consumer Price Index, unemployment or employment figures like the NFP, retail sales, industrial production, producer price index, gross domestic product, and interest rate decisions. So there's some of the news events which can affect currencies. When we're talking about stocks, of course, we're talking about obviously quarterly reports, that sort of thing. So for this purpose, let's keep on currencies. So these are some of the economic indicators which can affect the currency market. Let's go in a little bit more detail about some of these. Okay, let's start off with the Consumer Price Index. Now, this is a monthly event released once a month. It is a percentage, and it measures the change in price of a basket of goods and services. In other words, it's inflation. Now, the higher the percentage, the higher the chances of the central bank raising interest rates to combat it, which basically means then potentially that currency or that currency from that country in question where the CPI is coming from can potentially get stronger. So it's a news event driving the market. I'll give you an example of this. The UK, obviously, as you can tell, I'm a Brit, so please forgive me and don't hold that against me. But the UK, obviously, with a Brexit fiasco, for lack of a better word, they suffered, certainly around 2017, they're still suffering now from a big rise in inflation. Clearly because obviously the pound was struggling against the likes of the euro and dollar, and the UK is an island, so it imports a lot of its stuff it needs, food, etc., and it was making it more expensive. So inflation went up. So CPI went up. It actually went up to nearly 3%, which is extremely high. So what happened was, because the CPI was higher, analysts out there then started to say, right, the central bank's going to raise interest rates, which in turn made the sterling on the back of this event stronger. So again, this is something which you need to keep an eye on because it can move the market. Same with CPI for the United States, Eurozone, etc. However, the lower the CPI is, okay, the lower the chances are the central bank in question raising interest rates, which can potentially weaken that currency in question. Retail sales. This is another key economic indicator. Released on a monthly basis, again, it is a percentage, and retail sales measures the sale of goods, surprisingly, from the retail sector. If there is growth in retail sales, it indicates that the economy is growing alongside consumer confidence. In other words, the modern day economy really relies on, likes of myself, your good people, spending our money, us going out there, buying the latest iPhone or Samsung, the latest clove line or whatever. It relies us to spend our money because it makes sense. The more money we spend, the more money goes back in the system, then pays for industry, manufacturing, etc. So the more we're spending the money, our money, more things we're buying, more confidence we are. So again, it's a positive sign for the economy, which could indeed lead to a stronger currency in question. Gross domestic product. This is another key economic indicator. Released on a monthly basis. Again, it is a percentage. And it measures the overall health of a country. The higher percentage shows the strength of that country's economy, which in turn could lead to a stronger currency. Another big event, or a big news event or economic event, of course, certainly when it comes to currencies, is the non-farm payroll. This is the United States. Okay, released on a monthly basis, and it's 1,000 number. It's okay, it's not a percentage, and it's usually released on the first Friday of the month. Sometimes it's not, due to maybe certain holidays getting in the way or certain other events, but usually it's on the first Friday of the month. And it measures the total new jobs from the previous month, not including farm workers and actually military servicemen or servicewomen. The reason why this is a key driver, because 80% of those who put into the US GDP comes from the employment. So, excuse me, if there is indeed a good number of new jobs being taken, then it is a good sign that the US economy is doing well, which could then indeed lead to a stronger US dollar against the likes of the majors, the euro, the pound, the Japanese yen, the Swiss franc, etc. And gold. The one thing about this event, not so much now. Now, to be honest, the market is a little bit used to it. It still causes a lot of volatility, but not as much as it used to back in the day when I was trading. The NFP can cause extreme volatility, so it's not always for the faint-hearted. And finally, the other big announcement, certainly when it comes to currencies, is interest rate decisions. These come around about 8 times a year, depending on the central bank in question, is a percentage. And there's 2 things that analysts always look out for. 2 words in particular. There's tightening, and tightening is when inflation is high and the economy is growing. The central bank in question may increase interest rates to encourage saving and attempt to lower inflation. In other words, central banks will raise rates when things are good. Okay, they don't need to spend our money so much. They need to fight inflation, and they need to encourage us to save. The second word to look out for is loosening. This is when inflation is low and the economy is sluggish. The central bank in question will then lower interest rates to encourage us to borrow more and spend our money. Prime example of this is the 2008 financial crisis, which we are still reeling from. We're not out of that at all, despite what people think. And don't forget, the central banks around the world lowered interest rates to make things cheaper for us to borrow. They encourage businesses to borrow, inject capital into the system. They lowered it for us, individuals, so we would go out and spend more money. So loosening. So tightening basically is a good sign because it means the economy is growing, so that currency in question could increase. Loosening, or hints of loosening in the future, can potentially weaken that currency, make that currency weaker. Other such events, especially for currencies, is press conferences and minutes. Now, the market monitors these press conferences and minutes released by central banks to try and read into when they may raise or lower interest rates in the future. If the speaker is hawkish, then the currency could get stronger. Very good, James. What does hawkish mean? Hawkish basically means that the speaker in question is a bit more aggressive in what they're saying. Okay, i.e., they're more positive about the economic outlook. They're more dropping hints or possibly increasing rates in the future. They're called hawkish or hawks because apparently hawks are aggressive birds. And if that's the case, it could indeed make the currency stronger. If the speaker, however, is on the other side is dovish, and dovish basically means they're a bit more cautious, gentler, not so optimistic, maybe a little bit pessimistic, maybe even drop hints that they might do more quantitative easing or might lower interest rates in the future, then the currency could indeed get weaker. Now, the key central banks to watch out for, or the news events from these central banks to watch out for, includes the likes of the FOMC, which is Jeremy Powell, ECB, Mario Draghi for the time being until he's replaced very soon, and the Bank of England, Carney, Mark Carney, just to name just a few. There's now political impact on currency prices. General elections tend to have a large impact on a nation's currency. Now, traders monitor elections in case they could cause political instability, which in turn could cause volatility in the currency markets. This is due to the fact that a change in government could result in a change in fiscal and monetary policy. Look at the Brexit, everyone. Any news or story about that, look what happens to the sterling. But anyway, I'm digressing. Let's do some examples. The US general election, November 2016. Big surprise to everybody, of course, for Donald Trump, a former reality TV star, won the most powerful, position in the world. But anyway, politics aside, big surprise to the market. On his election win, as you can see, the US dollar skyrocketed against a number of major currencies, went on a massive bull run. This was obviously due to the fact that with him going into power, it was generally considered that him giving tax breaks, which was one of his election promises, would inject a lot of finance into the US economy, which made the dollar stronger against the majors, etc. And the stock market start to move because there was a lot of optimism that his input, his now place in power, would affect it in a positive way. And then we had the French general election. Macron beat Le Pen in April 2017. Excuse me. And there was a worry at the time that the populist votes were beginning to win, so the euro was struggling, etc. But Macron up against Le Pen, who was very much a populist believer, and with even dropped hints of if she won, she may take France out of the EU, like the UK. However, when he won, there was sort of a bit of a sigh of relief, and the euro managed to gain strength and actually opened on a gap on his election win. Finally, we have the UK general election in June 2017, resulting in a hung parliament, which sent the British pound crashing because there was no political stability, which of course affected the sterling in quite a heavy way. Now, there's two methods of trading the news: directional bias and non-directional bias. Directional bias means that a trader expects the market to move in a certain direction once the news report is released, i.e. the trader has an opinion. Because of this, because he or she has an opinion, means they need to know all about the news event. They have needed to have done their research. For example, if it's an unemployment announcement, they've needed to go back and look at where the employment rate has been. Has it been declining, or has it been increasing over the last 6-8 months or so? If it's inflation, what's been the root of inflation? So they need to know about this event. And they need to be mindful of what analysts actually think, because days and even weeks before, analysts may have formed some kind of forecast. And this will need, and in many cases, then you will see there's the expectation of what they expected to come and the actual outcome of the actual number. And sometimes this can lead to the whole buy the rumor, sell the fact scenario, something I will talk about. Then you have the non-directional bias. Now, a non-directional bias approach is when a trader pays no attention to directional bias at all, so they don't really look at the direction where they think it's going to go, all the finer details. They haven't looked back on the story. They haven't checked out previous data. They're just aware that this event is happening and it will create movement in the market. This method, however, doesn't require so much research, but does require planning, because the trader will need to know exactly where to potentially enter the market, no matter what the market move or direction the market moves in. And this leads me to one of the strategies which directional bias uses, and this is known as the straddle strategy. The straddle strategy is a method of trading when a trade is looking to go in either direction. The strategy is not dominated by one direction or the other, but it does, like I say, require preparation and planning. And let me give you an example. You know, a big event is coming up. Okay, say an unemployment event, or say the NFP, or maybe interest rate decision. And you look back on your charts on the direction the asset has been particularly going. And if you see, or if the trader sees the market has been trading almost in a range, so he knows roughly before the event where the resistance has been trading and where the support has been for that asset, he or she can then work out potentially that on the back of this announcement, if it does indeed move the market, it might be a good idea for me to set a pending order going long, say 5-10 pips above the resistance level I'm seeing. Or, I don't know for certain what direction it may go, I will set a pending order to go short, again, 10 or 5 pips below the potential support. If indeed the market reacts in a positive and the asset goes higher and breaks that resistance, then the pending order will be activated going upwards. If it does go up, it doesn't matter, this order won't be hit, so you just close it or delete it. However, if the market is negative and goes the other direction, then of course it will break the support, triggering that potential pending order. To protect themselves, what the trader will do will then set a stop on the long order, slightly maybe 10-15 pips below the resistance they've seen, in case it does a bounce and goes back to ranging. And indeed, same with the pending order. Sets the stop, again, just above the support, ready to trigger to protect themselves. That's a straddle strategy. So your idea is you've got a pending order going long and you've got a pending order to go short. There are dangers, of course, of the straddle strategy. Sometimes, because of the volatility, a pending order may trigger in one direction and then revert back in the other direction, basically stopping you out. However, the positive side of this, if that is the case, if the other order is then triggered in the opposite direction, it could go on to profit more than the loss. But the danger is then, of course, it could trigger that position and the asset ignores the news and then goes back to returning into a range, meaning you've stopped out on both positions, losing on both. So it's not foolproof. Though this strategy does indeed or can indeed work with spot and CFD, it's more popularly used by traders who trade vanilla options, where they do a put and a call option at the same strike price. That, if there's volatility, is a good strategy which can work. So vanilla options is one method which most traders use, the straddle strategy, though like I say, it can use with spot, but with vanilla options it's more preferred. So really, when you're covering the news and you're looking for news events, preparing your trading day really means you need to be aware of what is going on. Because you need to be aware of it to prevent any potential surprises in the future. You should be preparing your trading week, and not be funny, maybe even your month, depending on your trading style. So that means you need to be aware of what is appearing on the financial calendar available on all websites. You need to know what the news is, what the story is, what the market's talking about. You need to know possible opinions and analysts, people, what they're predicting maybe some asset may go to, and why they are predicting where that asset may go to. So you really need to be up to date on what is happening. Now, up and coming education events. Within the next day or so, of course, I will be releasing the June schedule. I will do more strategies next month because I must admit I'm getting a little bit bored doing quite a few topics. I'll do a few more advanced topics as well. So be prepared for the new schedule coming up in June. If you wish to speak to me, by all means you can. You can email me at james@strattonmarkets.com, or indeed you can become part of my exclusive following on my Twitter account, where I do occasionally share market updates and news events with a particular style, my particular way of doing things. My Twitter is @jtruscothic. Before I move on to questions, bear in mind we will be talking about online trading and CFD trading. And like with all events, it does indeed carry a great deal of risk. So I do suggest you do your own due diligence and your own research and know the risks at hand before entering any trade. With that out the way, is there any questions at all? Anybody like to ask me anything in relation to this topic or maybe any other topics? And if I know the answer, I will certainly try and answer it for you. Any questions at all? Okay. Did I go too fast on any particular topic or any particular area you may want me to cover again? Okay. Have I put everybody to sleep? Did everybody at least find it useful or insightful? Okay. Is there any maybe subjects or topics you would like me to do in the future? Okay, if there is no questions or no bits and pieces, don't forget, if you have a question later down the line and you wish to contact me, you can contact me there, james@straddlemarkets.com, or like I said, indeed, follow me or direct message me on Twitter. What I will say then on that note, can I have a big thank you for everybody who attended tonight? Special shout out to Colin. Colin, great to see you again, my friend. It's been a long time. Nice to see you. And a shout out to, I believe it's Neve Bremner. Nice to see you. First time you've come along. Pleased to see you. I hope you at least found it insightful and useful. Till next time, depending on where you are around the world, can I either wish you a good morning, good afternoon, or good evening? Like I say, depending on where you are around the world. And look forward to seeing you next week. And until next time, every single one of you, trade safe.